Well, back with India Market Open right here on NDTV Profit. Now, energy seems to be a very buzzing sector simply because one, oil prices have inched up a little bit, and two, lots is happening. Remember, there is also a new fund offer underway, which will, once the proceeds are done and the NFO is closed, deploy that capital in the space. And usually these things have a technical impact on specific pockets as well. So let's talk about all of these aspects with somebody who tracks this space very closely, Probal Sen, Senior Research Analyst of India Oil and Gas Sector and Institutional Equities at ICICI Securities. Probal, great having you as always. Thanks for taking the time out. I hope all is well. Just trying to understand, let's break this down and let's talk about upstream first. After a while, we've seen continued positive moves in prices of companies like ONGC. Reliance is nudging new highs. Oil India is doing well. You reckon this is, usually is cyclical by virtue of the oil price moves, but is it as cyclical, or could this be a bit more steady, the prospects of the upstream oil companies?
I think two things have happened. At the end of the day, if you look at upstream companies, there are only two factors that move prices. One is what is happening on the production front, and two, what is happening on the realizations front. So if you really look at the way that the last 6 quarters have played out, both of those things have actually played out positively. ONGC, after a long while, seems to be on track to grow its production meaningfully over the next 2 to 3 years, thanks to the startup of its KG Basin asset. If you look at the guidance that they have been giving very clearly, I think 6 to 7% growth, if not more, can be expected, thanks to the 30 to 40,000 barrels of oil per day and about 10 to 12 MMSCMD of gas per day that they are talking about producing from this asset for the next 2 to 3 years. And more importantly, in terms of realizations, what the government has done with the kind of windfall tax policy that they have been following is they have ensured that there is a lot less uncertainty about both oil and gas realizations for both Oil India as well as ONGC, in the sense that unless there is a significant bearish run on crude, one can be rest assured that they will be making at least $75 to $76 a barrel. And I think that is very, very significant because it takes away a lot of the volatility that used to be the case in the past. Because one, the crude prices themselves were, a lot more volatile than they have been recently. And two, because there was always some sort of a subsidy or a takeaway or something else, the quantum of which did not used to be known earlier. Now, with the very clear stated policy that anything over $75, $76 goes to the government, anything less than that comes to the companies, and with all indications that crude will likely remain above $80 or $85 in the foreseeable future, this realization is about $18 to $20 higher than what they've earned in the last 7 to 8 years. When you combine this with the fact that production performance actually has been encouraging, both for ONGC and Oil India, in fact, the guidance that they have been giving and the production performance over the last 6 quarters suggests that they will probably show the highest production growth that they've ever done in the next 3 to 4 years on an annualized basis than what they've achieved in the last 10 years. So you put that two together, plus the fact that the gas realizations also are fairly stable now at $6.5 to $7, with additional delta that can come from either premium gas pricing or the new well premium that is being discussed and is being formally finalized, where new wells drilled and production from those is likely to get a 20% premium on the normal APM gas prices. So, it's just a convergence of factors that just creates a lot more positivity in terms of, how these companies will fare over the next 3 years.
A lot of people talk about how cyclical factors notwithstanding, the multi-year breakouts that are happening, there's this technical factor of this ICICI approved ETF on, which will also deploy money. They've turned constructive, by the way, because they are not sell side. I'm just saying that we're speaking to their fund manager who said that this time around it seems like the energy needs India's energy needs are a lot more trending higher over the course of the next few years, and therefore the business prospects for some of these businesses will continue to be positive. Are you therefore, Probal, constructive on any of the upstream names? Would you buy an ONGC, Oil India, for that matter, or Reliance Industries?
Yes, absolutely. I think we've had a buy on Oil India and ONGC for a while now, and we see no reason to change that particularly, even after the run up that's happened in the stocks in the last, let's say, year or so. If you look at where their multiples are still at fairly comfortable levels, given that we do expect consolidated earnings for both companies to, sort of show an accretion steadily over the next 3 years. I would tend to think that there is probably still some steam that is left in these stories. The only caveat here is they will have to continue to deliver production growth. I keep coming back to this, that as an upstream company, the one thing that held them back even more than whatever uncertainties were there as far as realizations or subsidies or other factors are concerned is that fundamentally an upstream company has to deliver production growth. And if there is one thing that has changed in terms of perception and expectations from these two companies, it is that production growth will continue to be fairly strong over the next 3 years. As long as that execution remains on track, I see no reason why these stocks cannot continue to outperform over the next 12 to 18 months.
Probal, good morning. Tamanna here as well, and great to speak with you today. Now, it's just as a space, the oil and gas sector seems like it's maybe set for a bit of rough weather next couple of quarters. We spoke about upstream. Let's get your sense on downstream. I know you can't speak about some of those companies, but let's give an overview and anything specific that you can add. Are we in for a bumpy Q1 at least, or do you see the pain extending?
No, I think Q1, as you rightly mentioned, is likely to be weak for all the companies who have an oil to chemicals business, including Reliance. There is no doubt that the GRM softness continues to sort of sustain slightly longer than, frankly, what we were looking at. Even in the advent of the US driving season, there hasn't been as much of pickup in product spreads as we would have imagined. So to that extent, you're absolutely right that downstream margins remain a little bit under pressure. The only silver lining here is that, at least from an OMC perspective, the retail fuel margins continue to be slightly higher than historical levels or normalized levels, as they say. They are averaging about 3 rupees for the quarter, but they have ramped back up to around 4.5 rupees. And I'm talking only retail fuel, petrol and diesel on a blended basis. They have ramped back up to around 4.5 rupees plus. So the way to look at it is that on an integrated basis for the full year, the expectation is that they can probably still do about 6.5 rupees a liter on a blended basis, even if full year refining margins, sort of ramp back down to $6.5, $7. I'm building in Singapore benchmarks at, let's say, 4.5 for the full year, which translates to a 6.5 kind of a level for an HPCL, for example. But if marketing margins actually come in and, there's no pressure to sort of reduce retail prices, I still believe that, there may not be too many downgrades to earnings. Having said that, one thing one has to remember is that FY24 was an exceptional year in terms of profitability. Whichever way you slice and dice it, FY25 earnings will be softer on a sequential basis. What needs to be looked at, however, is from a 3-year window, as long as operational metrics continue to improve from a refining complexity perspective and marketing margins get back to normal levels, fuel pricing rather gets back to, a business as usual scenario, I think that should sort of support the stock from a longer term. But yeah, the next 3 to 6 months does look like slightly tough period from a margin perspective.
So how does that quantify in your view, Probal? And, I'll take off from that FY25 relatively is going to be tougher than FY24 for oil marketing companies. You're going to see, softer growth numbers, etc. By how much?
I think if you look at our published estimates, we were building in about 15 to 18% decline in earnings on a consolidated level for HPCL for FY25 versus 24. And that built in a combination of somewhere around $8 to $9 of GRMs, but 2.5 to 3 rupees of margin. What is a likely scenario could be that you could have a $6 to $7 GRM, but a 3 to 3.5 rupees of margins. So at the moment, we would believe that, that's the kind of earnings that one lives with for HPCL, which is very clearly a, mid double-digit decline from the record levels of FY24.
And you can extend it, I suppose, on the same basis to a BPCL as well, because they're sailing in the same boat fundamentally. So Probal, would it be fair to say that city gas distribution companies would be the bright spot in this space on relative terms?
I think as far as CGDs is concerned, the one crucial thing is the kind of expectation that is getting now built in that LNG globally is entering an era where there could be a significant oversupply, if not in 25, but starting from CY or rather FY 26 and 27. All reports indicate that there's around 170 to 190 million tons of capacity addition that is likely to happen over the next 4 to 5 years against probably an annual demand run rate of around 25 million tons or so, which means that the LNG market may remain in surplus for a fair while. So that is obviously good news for Indian operators, because remember that the supply of nominated gas for the priority segments has been going down significantly, which is having to be met by either premium domestic gas or through LNG sources. So that moderation, I think, is a very, very crucial aspect, in terms of how the margins and price competitiveness can be there. Plus, the fact that they have managed to increase their prices right now, at least Gujarat Gas and MGL, means that they are looking to protect and focus on their margins at this point of time. So yes, I think structurally speaking, demand for gas continues to increase, and if margins also stay resilient, I think this sector will continue to do well.
So, Probal, ahead of the Q1 earnings season, what would you say would be the top buy calls in each of these segments?
Honestly, we don't really give tactical buy calls, to be very honest with you. But if I look at which stock can actually deliver very strong numbers, I would believe that GAIL probably stands out for this quarter, given the softness in spot LNG and the kind of volume growth that India's gas consumption has seen. Our sense is that GAIL can actually deliver fairly strong YOI and QOQ growth numbers for this quarter. And even structurally, if we really look at the factors that I just spoke about, I think GAIL continues to probably be the strongest beneficiary and can see improvements across all segments as far as EBITDA is concerned. So that remains a preferred pick in the space at this point of time.
GAIL is the preferred pick. In terms of RIL, how do you see the pain points panning out for Q1?
Q1, what we are looking at basically is EBITDA going down to about 400 billion against the 420 odd billion that they reported in last quarter. Again, as I said, led primarily by OTC weakness, where we believe that against about, I think, 16,500 crore of EBITDA, this quarter could probably see a decline down to about 13 odd thousand crores. And also, what is interesting is that because the growth that is coming this quarter is primarily from retail and Geo, which are the consumer segments where strategic stake sales have happened, the minority interest as a proportion of overall profits will go up. So net profit will actually see a slightly more higher decline than what your EBITDA would suggest. So to that extent, I think, again, for the first half, OTC might continue to drag down the earnings, but with the huge ARPU increase that will start to reflect from the second quarter onwards, I think Geo would probably help offset some of the OTC damage in the second half, for the earnings.
So it's all going to be about Geo as far as RIL is concerned. Thank you so much, Probal, for speaking with us today. Always a pleasure to get your sense. And, we're just putting the spotlight on the oil and gas space ahead of the Q1 numbers. It's going to be a bit of a tough kind of a quarter for both upstream and downstream companies, but city gas distributors could be the shining bright spot. GAIL is the top pick from ICICI Securities.